Ever feel overwhelmed by all the talk about stocks, bonds, mutual funds, and then boom, someone drops the word ETF, and it all gets even murkier? Don't worry, you're not alone. Today, I'm breaking down in plain English what an ETF actually is, how it works, and why it's one of the best ways for new investors to get broad, powerful diversification without the confusion or the risk of picking the wrong stock. Let's ride this ETF wave together. So, what is an ETF, really? ETF stands for Exchange Traded Fund. Think of it as a big, smart basket that holds all kinds of investments, stocks, bonds, sometimes even real estate or gold. The magic? Instead of buying just one company, you're buying a whole team. You can snag an ETF on the stock market, just like any regular share of Apple or Coca-Cola. With a click of a button, no mystery, no minimums. Let me give you my favorite analogy. Imagine you want the health benefits of lots of different fruits, apple, blueberry, banana, but don't want to fill your fridge with 20 separate fruit baskets. So you grab a smoothie. Same with ETFs. Rather than buying 30 individual stocks and stressing every quarter, you just sip the investment smoothie. It has a blend of everything, super efficient, zero stress, and packed with goodness. ETF versus individual stocks. Okay. Here's the difference. Buying one stock? Imagine putting your entire lunch in a single paper bag. If that bag breaks, ouch, lunch is ruined. But ETFs? You split your lunch across Tupperware, Ziplocs, and a secure lunchbox. If one part fails, you've got plenty more to rely on. That's diversification, which simply means not having all your eggs in one basket. And let's be honest, for most beginners, the fear of picking a bad stock can paralyze you from even starting. With ETFs, you're invested in tens, hundreds, or even thousands of companies at once. If one tanks, the rest cushion the blow. ETF versus mutual funds. Here's a question I always get. Are ETFs and mutual funds the same thing? Kinda, but not really. Both are baskets. But ETFs trade all day long on the stock market, so you can buy or sell anytime the market's open. Mutual funds? One trade per day, after the market closes, at whatever price is set. Plus, most ETFs have lower fees, no investment minimums, and are tax-friendlier. Think of ETFs as the on-demand, modern version of mutual funds. More flexible, fee-light, and you are totally in control. The first ETF in the US, the famous SPY, started in 1993, tracking the S&P 500, the 500 biggest American companies in one go. Since then, explosion. Now there are thousands of ETFs tracking US stocks, European stocks, gold, bonds, even niche stuff like cloud computing, marijuana, or robotics. The best part, ETFs have democratized investing. No need to be rich or fancy. Anyone can start with $10 and own a piece of hundreds of companies. ETF structure. So what's inside your ETF basket? Each ETF owns actual underlying investments. When you buy an ETF share, you're instantly a partial owner of everything inside that basket. Apple, Tesla, Microsoft, whatever's included. Some ETFs have active managers, but most beginners stick with passive ETFs that simply mirror a whole index, like the S&P 500, using computers. That means more predictability and less cost for you. Index ETFs. Let's talk about index ETFs, the ultimate no-brainer for most new investors. They just follow an index. Think of it as a list, like the top 500 companies in America or the entire stock market. The big deal? They're insanely cheap. Fees often tiny, like $1 per $1,000 per year. Super diversified. You don't have to pick winners. The index does that for you. Top beginner picks. SPY and VOO, S&P 500. QQQ, NASDAQ, VTI, total US market. For most, you could invest in just one of these and be set for years, honestly. Want to spice it up? There's an ETF for just about every flavor. Want tech exposure? Try XLK or QQQ. Prefer healthcare? XLV is for you. Dream of the clean energy transition? ICLN got you. Even thematic funds. Robotics, cloud computing, gaming, AI. Like ARKK or BOTZ. So yes, you can express your beliefs and diversify. all at once. Y'all know why this channel exists. Game-changing dividends. Did you know there are whole ETFs built just to collect high dividend stocks? VIG, SCHD, DVY, HDEV, serious workhorses that pay you cash every quarter. No need to research each company yourself. The ETF does it all, and you just collect. Set up DRIP, and those dividends buy you more shares. Cue the snowball effect. Bond, gold, and alternative ETFs. ETFs don't end with stocks. Looking for stability or to hedge against inflation? Check out bond ETFs like BND, TLT, AGG. Think of these as the seatbelt for your portfolio. Gold ETFs like GLD, IU. When the economy wobbles, gold can shine. Real estate ETFs, REITs, V&Q, SCHD. Yes, you can own a slice of towers and malls via your phone. That's why even old-school investors are ditching cash for diversified ETF exposure. Unlike old-school funds, you can buy and sell ETFs in seconds. No weird waiting periods, no end-of-day calculations. Fancy a limit order? Want to set an automatic stop-loss? ETFs allow full trading power, same as any stock. You're always in the driver's seat. Let's talk costs, because small leaks can sink big ships. Most broad ETFs have expense ratios under 0.1%. That's about $1 a year on a $1,000 investment. Some brokers offer zero commission trades, too. Rule: always check the expense ratio. The lower, the better for your compounding machine. Worried about Uncle Sam? Good news, ETFs are usually tax efficient, meaning you only pay taxes on dividends and realized gains. Hold them in a Roth IRA or 401k. Zero taxes as long as you follow the rules. Outside those, you'll pay when you sell for a profit or get dividend payouts, some taxed favorably if qualified. ETFs make tax season a lot simpler than owning 20 different stocks. All right, so how do you actually dive in? Open an account at a trusted broker. Think Fidelity, Vanguard, Schwab, Robinhood. Search for the ETF ticker, like VOO, SCHD, VTI. Decide how much to invest. Even $10 is enough. Most brokers now let you buy fractional shares. Place your order, mark it for fast execution or a limit if you want to pick your price. Boom! Welcome to diversified investing. Want to really make this process effortless? Set up DRIP. Let your dividends automatically buy more ETF shares. The magic of compounding. Recurring investments. Automate a set amount every week or month. Sit back, relax. Wealth builds while you're busy living life. Let's talk real life. Meet Sophia, just out of college, nervous about stocks, started with $500 in VTI, set $50 a month auto invest. She didn't try to time the market or chase hot stocks. She trusted the process. 5 years in, she's got a steady, diversified account, survived all the financial headlines and market crashes, with zero fancy moves or stress. That's the beauty of ETFs. They grow with you quietly, steadily, automatically. Now, eyes wide open. ETFs are simple, but yes, they involve risk. The value can fall, no guarantee of profit. Some niche or leveraged ETFs swing wildly. Think crypto, biotech, or trendy themes. Read the fact sheet. Know what's inside. Never buy only for hype. And never put all your eggs, even ETF eggs, in one basket. Biggest ETF traps to dodge. Chasing last month's best performer. What goes up fast often comes down. Ignoring fees. Fancy themed ETFs sometimes charge 0.5% or more. Short-term trading. ETF work best as long-term investments, not get in, get out. Using dodgy brokers. Always stick with reputable brands. Forgetting to rebalance. Check your mix 1-2x a year. Ready to put a portfolio together? For beginners, simple is smarter. Example: 60% total stock ETF, VTI or ITOT. 20% international, VA. 10% bonds, BND. 10% dividends, SCHD. 1 to 5 ETFs is plenty. Don't add complexity just for the sake of it. Let your core funds do the heavy lifting. Surge Spark. Think of this as building a smoothie. Bananas for steady energy, bonds. Berries and greens for vitamins, stocks from different sectors. A splash of protein powder, dividend ETFs. Blend them together, sip every month, and watch your financial health soar over time. ETFs are your nutrition plan for long-term wealth. Quick tips before you hit buy. Always research your ETF at ETF.com or Morningstar. Look for assets, fees, and holdings. Read the prospectus. It's not just legal mumbo-jumbo. Schedule a quarterly calendar alert for portfolio checkups. Get advice from trustworthy, data-driven channels. Hello, Dividend Surge. Wherever you're starting, just start. Pick a broad ETF. Make that first tiny deposit. Automate the process and trust in time. Investing success is about time in the market, not timing the market. ETFs are here to stay. They're reshaping investing, breaking down barriers. Every year brings new, creative ETFs. You'll never have to settle or be bored again. Keep learning, keep adjusting, but never lose sight of that simple, diversified ETF core. To sum up, ETFs equals easy diversification, low fees, less stress. Start small, automate, review once in a while, keep learning. Don't overthink. Consistent action beats perfect timing. And remember, this video is for educational purposes, not financial advice. Always do your own research before investing. If this helped demystify ETFs, smash that like button, comment your first ETF pick, and hit subscribe to join the Dividend Surge ride. Stay tuned for our next video, Top 5 ETF Mistakes Beginners Still Make, and how you can dodge them.